Hilton brings you new ways to stay, with experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Reality radio for a really great future. We're talking real money.
Well, hi. Hello. Welcome to our little get-together. I'm Don McDonald. Over there is Tom Cock, and we are talking real money.
Well, it was this or do the yard, and then it doesn't look too good to do the yard today, so I guess I'm inside doing the show. So.
We do the show live on Saturday, then we turn it into a podcast, and right before we come on, they do the weather. And the weather really literally could have been done in 1 second, because he did all this Phil stuff, and then he goes, the weather in one word, wet. Wouldn't it be refreshing? It's like, tomorrow, wet. Day after, wet. Day after that, wet. It's going to be wet.
I've seen less water at hydroplane races than I see here today. So,
I got to tell you, we had like 30 hours of nonstop rain in Florida.
Really?
Yeah, it was one of those things like you see coming into California, those rivers of moisture. Just nonstop coming in off the Gulf of Mexico. Just tons of moisture.
We have one of those rivers of moisture that's supposed to break up by early May, so we're looking forward to that. The river will end. That's it.
That, ladies and gentlemen, is life in the Pacific Northwest.
There you go.
So glad you could join us today. And if you'd like to call us with your questions, comments, whatever it is, give us a holler at 855-935-TALK, 855-935-8255. And you can call that number anytime, too. But call during the show when we're here, which is 3 to 5 Eastern, noon to 2 Pacific time, 855-935-8255. And I want to read you a really, really important story before we get into the bulk of today's program. And I just found this particular story just a little while ago. So, it's
stand by for this important announcement.
I got to make sure that I get this right. This is from CNN. The
you need some music or some
are celebrating.
Ooh.
The Dow Jones Industrial Average ended at an all-time high again. Wow. Oh, wait, this story's from 2013.
What? Oh, wait a minute.
Wait, you mean like we've had all-time highs before?
And again and again and again. I mean, it's getting kind of repetitive, right? I mean, it's like over and over and over.
You keep reading the stories.
Oh, okay, but I tell you what doesn't get repetitive is when Robert Schiller's cape tops 40 and then the shaking really begins, the nerves come jangled, and you're just not going to, the market's got to go down, Don. Stocks have to go down because the cape is over 40, which is the highest. Hold your breath together now, since October 2000.
Yeah.
Which is, you probably can remember, it was not a great time for stocks, right? And they're the most expensive, basically, other than 2000, since about 150 years or something like that. Long time.
Well,
Does that make you nervous?
Here's one of the interesting things about the CAPE is based on prices versus, it's very similar to a PE ratio, prices as divided by earnings.
Yeah, shares of stocks divided by how much they're producing.
Yeah, it's a longer-term valuation, but the reality is, in the past, the CAPE has told us absolutely nothing when it's been ridiculously high.
Now, correct me if I'm wrong, and thank you for that, but the CAPE is just based on the Standard & Poor's 500, or is it based on the entire U.S. market? Because I think it's just the S&P 500.
It is the S&P 500, correct? Sir.
Okay.
Yes, you are.
So remember, by the way, in the early 2000s, actually for the aughts, the S&P 500 had a very crummy decade, but smaller companies, international value had a pretty good decade.
Not just pretty good, really good.
Yeah, really good. The other thing is, even if you knew that this was the record high Friday was not going to be repeated again for, I don't know, let's say 3 years, what would you do? Where would you move the money?
Yeah. Where would you go? And here's the thing we forget is that prices today, the price you pay today for a stock, is based on not what it has earned in the past. We confuse past tense, present tense, and future tense. The price of stocks today is based on what people think stocks are going to earn in the future. So what that high CAPE is telling you is that investors expect earnings to rise to meet the price.
So the anticipation is that the companies will create more earnings in the years to come, that the economy will continue to get better, that will flow to those firms, et cetera, and therefore prices are higher.
While we don't predict the future, there are good reasons for those expectations. One of them is COVID. COVID depressed earnings for a lot of companies. Even though they've been posting good earnings, a lot of different companies have been posting good earnings, the expectation is once we get past COVID, that those earnings will just go crazy.
Can you say the COVID sickened the earnings?
Yes, COVID sickened the not only millions of us, but the economy too. 855-935-TALK, our number. Give us a call.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
See ya.
Your guides to a really great financial future. Tom and Don are talking real money.
Hi, everybody. Welcome back to our little get-together called a radio show. I'm Don McDonald, Tom Cock, right over there. Give us a call, 855-935-TALK, 855-935-8255. And we will help you out. We will help you manage your money better than you have in the past. So give us a holler, 855-935-TALK, 855-935-8255.
The question on the table is if stocks are at a high that they're not going to see again for 1, 2, 3, 4 years, whatever it is, what do you do? Where do you move the money? Should you be timing it all? And what asset would you buy? Here's one.
Yeah, what would I buy?
It wouldn't be real estate.
Okay, good.
Because that's trading pretty high. Wouldn't be probably cryptocurrency,
no,
right?
It would never be that.
But here's one that's paying 7.12% risk-free, annualized, 7.12%.
Guaranteed?
Risk-free. Guaranteed. Well, guaranteed, yes, as long as the U.S. government continues to pay its debts.
Well,
because
of all the guarantees out there, though, that's one of the best ones.
It generally is. The I bonds. You are the one who brought this to my attention. Shocking. Shocking. 7.12% for the new series of I bonds. You can buy those now through April 22nd. Mm-hmm. And it says here the rate is guaranteed, but the rate's only guaranteed for 6 months. You didn't tell me that part. I want more disclosure next time.
No,
you're hustling
the
me
rate
into the government
can go
thing.
as low as zero.
Yeah, I know.
Can't go lower than zero.
It's set twice a year, and you can buy $15,000 per calendar year. So is that each person in my household can buy? Can I buy that for my wife, myself, and my daughter?
I don't know if your daughter can, but the two of you can. I know that.
So I could put in $30,000,
and you can put in an additional $5,000 if you have your tax refund put into I bonds.
That's funny. You mean they're sending me money?
Yeah. Oh, yeah. That's right. Never mind.
Waiting for that one to happen. It's been a while. No, that's not going to go. So, and I think you know the address, right? To go if somebody's serious. I mean, because we had people last time you talked about this that ran out and bought the I bonds.
I went out and bought one. You go to treasurydirect.gov, G-O-V. Just treasurydirect.gov.
And you just hook it up to your bank account or something?
Yeah,
send them the money?
You hook it up to your bank account. If you want to see one of the more archaic websites in America, if you want to just kind of take a trip back in time, this
is 1998.
You know,
welcome.
The front page with like 35, no, more than that, maybe 40, 50 different links on the home page.
Oh, goodness sakes.
It's really a bad site, but it's brought to you by your friendly federal government. So
your tax dollars at work. So you can go there.
Are not high.
And you can buy the I bonds 7.12%. I mean, that's astounding.
And that basically is what they're annualizing out is the rate of inflation.
6 months ago, it was just 3.5.
I know. I was all excited to get 3.5. So now I've done my deal for the year, and I'm just getting 3.5.
Yeah, I'm going to jump in and make twice what you are.
Yeah. See, you think you're special. No, it actually is. It's just you can't do very much, but it's a nice way to get a higher rate in times of inflation. It gives you some inflation protection, and it's not a whole lot of money. 855-935-TALK is our phone number, 855-935-8255. And we'll talk more about that in a minute. Jewel, you're up next. Welcome to Talking Real Money.
Good morning, guys.
Hey.
Or good afternoon, I guess. Let me clarify.
Absolutely.
So I have a quick question. My mom recently passed away, and I'm going through, boatloads of paperwork. And I happened to come across some paperwork from Hamilton Fund Periodic Investment Plan that it looks like my mom and my grandmother back in 1956 had purchased something from Hamilton Mines. But I have dug and cannot find anything that exists on a company like this.
Wow. Hamilton Mines.
Do you have an idea where I can go?
Yeah.
I hope there's gold in there somewhere. Hamilton Mines.
Periodic.
I'm looking. I don't see it.
Hamilton Group.
Actually, I'm sorry. It's Hamilton Group. Hamilton Group, but it says Hidden Treasure Mines, a Washington corporation.
Yeah.
Out of Yakima.
I am just having a concern here that this is probably not worth anything.
Sure.
Let's see. Hidden Treasure Mines. Yeah, I see Hamilton.
Yeah, in a few spots here, but I don't see anything.
Yeah, the Hamilton mine was, let's see. Yeah, this is all very. I am as. Let's see. I'm trying to find something on it. I
see they have some mines in Canada, but that's about all I can find.
Well,
I don't find anything here.
I am about 99.99999%. You're looking at something worthless. They did some sort of a periodic investment plan. Do you have anything on the certificate? Does it have the name of a registrar? Any name of any bank or other company
that would be a place to start.
Other than Hamilton?
Haskin and Sells, SELLS.
What was the first word?
In Denver.
Haskin?
Haskins.
SELL, Haskins and Sells. Oh, it's part of Deloitte now.
Oh, that'd be a place to start.
Haskins and Sells. They were the accountants. Any other names on there?
No, just Haskins and Sells out of Denver, Colorado.
Yeah, there is always the possibility. Here's one of the things I have suggested people do. Now, companies like Charles Schwab hate this advice. Schwab or TD Ameritrade or Fidelity or whomever it is. If you have an account with them, deposit the shares to the account.
They won't let you.
You sure? They used to.
They won't take them. Yeah, not anymore. They're very specific about what they will custody now. They won't. They'll just say no.
They used to take them, and then they were forced to find who owned them now.
Yeah, and those days are
darn it. Well,
sadly gone.
That tells you how old I am.
Unless they were already custodied there, then they would, but not today. No, now you can't walk in the door with that. No. I'm trying to think. I mean, the only other place I would go, since you said it was a Washington corporation, would go to the Washington Secretary of State. Start there, see if they have some sort of record, because oftentimes if the company was sold or something happened, they may have a paper trail of, who ended up with those assets. That might be another place to start. Other than that, I don't have a whole lot of great ideas.
Oh, I'm going to do some more checking, though, just because now I'm totally curious. But I'm pretty sure you've got a worthless asset. I'm going to bet on that, but I'll do a little more checking. Thanks so much. We appreciate you being there. 855-935-TALK is our phone number, 855-935-8255.
Tom and Don are talking
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
For your real life and real future, Tom and Don are talking real money.
Well, I'm checking with the Washington Secretary of State's corporate site.
Yeah,
there
you
is
can go there and look up companies.
There is no Hamilton Group listed.
No.
There's also no Hamilton Mining. There's a lot of companies called Hamilton, but not that name.
Yeah, I mean, you're going back to the 1950s here.
Yeah, my guess is it's gone, and it's been gone for a long time.
Yeah, it appears that they were in the mining business for a time, but it's hard to tell.
A long-term lesson on the hazards of owning individual stocks.
Yeah, owning any individual security at all, for that matter, stock,
you can
bond,
lose
whatever
out.
it is. So, yeah.
855-935-TALK, that's our number. John, you're up next. Welcome to Talking Real Money.
Hello,
Hey, John.
Tom and Don. Don, I've been listening to for over 40 years.
See, that's how old I am.
When Debbie was still a stockbroker.
Yeah, it's been a long time.
Yeah, I forgot to mention that. I just stepping in for Debbie here. She'll be back any moment, so I'll be off the show and she'll take
won't.
my spot.
She won't. She does not.
No?
She will never do radio again.
What? Never say never.
Yeah, I'll
One thing
say
I've learned,
never.
so.
She'll never do radio.
All right.
All right. What's up, John?
We started out looking at the best mutual funds, and then eventually came up with the in the 90s or so came up with the indexes.
Mm-hmm.
And anyhow,
They're just better.
Truly successful.
Yeah, they're just better.
Good for you.
We started out 50-50 because we were a little concerned, and then we realized that we're going to pass the money on to our heirs anyhow. So we went to 70-30 now.
Can I get you to stop there 1 second? Because John, that's a great lesson, by the way, because people have a tendency to get more conservative with their money as they get older. If you have money you're unlikely to spend and you're just going to give it to somebody, what you point out is exactly right. It should be in riskier assets, which you hope make more, and you leave more to them. But most people I see don't take that approach. They sort of forget, and they think, I don't want to see the market go up and down. Well, you don't really care because you're not going to spend that money. You hope to make 8 or 10% a year instead of 3 or 4. So thank you for raising that. It's a very, very important point.
Now, what can we do for you today? John?
Since 2000, and base rate is somewhere around 3%.
Can you go back? We missed the first couple.
We missed
the first part of that sentence, John. I'm sorry.
Back in the early 2000s, we went to I-bonds. Mm-hmm. We laddered. We could do through the bank, and then you could also do it online. So we were putting in like $60,000 a year, and the base rate on those right in the 2000s were like about 3% plus inflation. So they've done really well. But when in the idea of gifting a lot of things, you can't gift those. When you kick the bucket, you have to pay the taxes on that, which would be ordinary income.
Right.
And there's no way around.
Nope.
So, but anyhow, that's something to keep in mind.
Yeah, but again, that's kind of letting the tax tail wag the dog. Wag the investment dog. I think we overemphasize the tax ramifications of decisions.
And by the way, you can only buy a certain amount of I think you said you bought $60,000 a year. In today's environment, you can only buy 30 if there are two of you anyway. So it wouldn't be
25.
Hopefully a large part of your
30.
estate. 215. So that's a good point. But I think for a part of your portfolio, sure. I think this is a great idea at 7%. Why not? I mean, what's a 10-year U.S. government bond paying? 1.5 6 or whatever it is.
Not
so
much.
yeah, I think it makes sense. Yes. So why not?
But using that I-bonds to balance our portfolio is at 30% of fixed income. So it's really served its purpose from that respect.
Absolutely. I think that sounds great.
And the question I have to ask you is, my son recently sold his house, and he wants to put the money into the market. And I kind of remember you talking about either dollar cost average, like over 6 months or 12-year, whatever you feel comfortable.
No.
So
we only believe in dollar cost averaging if you invest as you earn it. So you're dollar cost earning, and so you invest in that way. But if he's got the money today, we have no idea what the market's going to do. It could go straight up for another 6 months, and he'd miss out on all that.
Yeah, I mean, the only caveat would be if he's going to use it within 5 years, then you'd set that part aside. But otherwise, the money would be invested. The market does have an upward bias, even month to month, certainly year to year. It's like 3 out of 4 years. What next year holds, nobody knows. But as Don said, you would just put the money in, and again, the only takeaway I would have is if you're going to use the money within 5 years, that part will go into fixed income.
Otherwise, if he's got a long period of time, invest. Thanks for the call, John. We really, truly appreciate it, and appreciate the long listenership. 855-935-TALK is our number. Give us a call, please.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Reality radio for a really great future. We're talking real money.
We're of the opinion, and I think we have a good basis for this opinion. We're of the opinion that there isn't much, if anything, in the way of talk radio topics that is more important than this one. There certainly is a lot more talk about things like politics, but really, is it as important as getting the money part right? The money part of life? I don't think so.
I don't know, sports radio?
No. Oh,
no.
Geez.
Okay.
All they're talking about is Aaron Rodgers.
Oh, goodness, please, let's not open that.
Von Miller was in the news for about 3 minutes,
worms.
and then thank you, Aaron Rodgers, for stepping into the void.
Henry Ruggs is really appreciating it.
Yeah, and Henry Ruggs. It's sports. Come on. It's
I was kidding.
Bread and circuses.
Yeah, but money's just gauche. I mean, you just don't talk about it.
But it's
something
so
you just
important.
Don't bring it up.
How do you live the life you want to live in the future if you don't have decent money? You got to have it. And 855-935-TALK is our phone number, and we will try and help you get it, keep it, invest it better, protect it, do stuff with it. Do all kinds of stuff. Bob, you're up next. Welcome to Talking Real Money.
Hey, Bob.
Hey, thanks. Yeah, thanks, guys. I got to tell you, I've been listening to you for about 20 years. Your common sense, disciplined common sense, I really appreciate. I am invested. First of all, I'm debt free. I have no mortgage only because I've outlived that mortgage, and so we're debt free. And I'm invested in 3 Fidelity index funds that are just, for the past 5 years, have just done fantastic. So here's my simple question. As cheap as money is, I think I have a $100,000 line of credit on my house, or I could just, refinance at a cheap rate. Why do I not do that and invest it in a good, solid Fidelity or Vanguard index fund? Wouldn't I be farther ahead?
Bob, do you need to have that 100,000 grow so that you could provide for yourself in the future?
No.
Then why would you do it? You will.
Yeah.
You are not.
I guess it would be fun money.
You are not going to be the next Elon Musk. Now we have to say,
No, or even
trillionaire.
Jeff Bezos. That's right. Because Musk is the richest man in the world.
Musk
now,
is
right?
heading for the trillion. He's heading for the first trillionaire.
Yeah, it's just you just be. And by the way, we could be heading into a 5-year bear market. I mean, you might borrow it, put it in. Who knows what could happen? No, I would never. Okay, as a general rule, I would not borrow
As a general
to
rule.
invest.
Now, we've talked though. He's right because we have talked about not paying off a mortgage early.
That's true. That's
to
true.
Keep invested, but we really do believe there's a difference between needing and wanting money. Somebody who needs to grow their wealth to have the $2 million or so that a lot of people, a ton of people, more than you think, are going to need to have in retirement to live very comfortably, sometimes requires taking some risk. And you can do it when you're younger, but if you can't, a 5-year bear market could cost you quite a bit of money, could put your house at risk if your real estate prices fall, even though you got a ton of equity in it. It's just, it doesn't sound like you need to do it. I guess if
You already
you want
said.
to, and it's truly.
Then how about some tiny little amount or something to go play around with?
Well, he's already
No,
doing it.
I think that's a bad idea. I wouldn't do it.
I think it's a medium idea. I don't think it's terrible.
We have a slight conflict.
Yeah, we have a
This is
slight
great.
conflict. I don't think it's terrible, Bob, but I don't see why you want to do it. You don't need it. Okay? Does that make sense? I hope.
It's the challenge, I guess.
Yeah. It's not a sport. It's not a sport. Money should never be a sport. If you want money as a sport, then take a nice little junket to Vegas.
Oh, you could watch the Raiders while you're there, too.
No one wants to watch the Raiders.
I'm sorry. Bad idea. Another bad idea.
A team with a wide receiver in jail and the coach.
Oh, the coach had to quit. It's every week is talk about drama. Good Lord.
Anyway.
No, I wouldn't. Again, unless I had to have the money, I would not borrow to invest it.
But I don't think it's a terrible idea. It's just not needed. Thanks for the call, Bob. We truly appreciate it. And your, again, listening longevity. We got a lot of long-term listeners.
Yeah, that's somebody said 40 years, which actually technically
Almost with me.
I know. That's okay. If you really want to go back, I started in the radio business locally 1974.
You weren't doing okay. One, that was in high
It
school.
was rock and roll. Yeah.
Two,
I could name all the songs too.
It wasn't
Yeah.
money talk. They weren't listening to you talk about mutual funds.
No, they
855-935 talk.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Yeah, show's back. See, that was painless, wasn't it? Particularly for you podcast listeners, because that was like a 15-second commercial. It's like, boom, done. If you listen to the live shows a little longer, but you got some traffic out of the deal. 855-935-TALK is our phone number, 855-935-8255. If you're live show listeners, you're listening on Saturday, here's how it works. Tonight you get an extra hour of sleep if you sleep until the same time.
Means
But
I'll get
Tom,
up at like 3:30.
You're just going to get up at
something.
3:30 instead of 4:30 because
I know. I'll be like, what?
You're
what's going on?
programmed.
I know. I can't fix it. So
I wish. Why won't
I don't know.
Congress-
I don't know.
Why won't
why would-
Congress just
I don't know.
leave us at something?
Which when you really consider it, honestly, if you're honest with yourself, they're so good at passing other stuff. I mean, they click through stuff so quickly that it's hard to imagine they can't get this done.
This one
So-
though doesn't cost anything. There's no tax bill associated.
Actually, I think it's a cost savings, isn't
probably.
it?
I don't know. It's just stupid to change times.
Yeah, because it's light longer then. I don't know, isn't it?
Who cares? No. Who cares about?
This show's about money, and that's about money because if it's light longer, then you have to use your lights less, right? With daylight savings time.
We're all
See?
using LCD bulbs. We already saved enough without using incandescents. Are you all LCD now? I am. All
no idea.
LCD. My entire house is LCD.
I have no idea. I don't think that thing on my desk is LCD.
Well, everything.
Anyway.
All right. 855-935-TALK is our phone number. Give us a call. You can also send your questions in to us.
Please.
At talkingrealmoney.com, which a lot of people do. A lot.
They do. They're shy.
So we got this one that Pam sent. And Pam says, we've been using Edward Jones, which I know you guys don't like because you say they have high fees. We have enough money with them, though, that we don't have fees on some of our accounts. I'm going to come back to that one.
Keep going.
I know we've already paid them up front. We have, and yes, we did buy things through them, but it was stuff we needed. We have long-term care insurance that can also be used as life insurance or the other way around. It's probably life insurance can be used as long-term care.
More likely.
We have term insurance that's going to be expiring pretty soon, and we have multiple Roth IRAs and traditional, and then we also have a money market account with them, and we also have our own work 401k that is separate, and we will be retiring in a year and a half. I'll be getting a pension and have a FERS supplement. FERS supplement?
Yeah. That's a retirement plan.
Oh, okay. Okay. Yes, FERS. Okay.
Yes. Mm-hmm.
It was spelled differently.
Would you think it's something to keep you warm in the coming wet and cold months or something?
Just wondering why you don't like Edward Jones. They've told us what our fees are. It doesn't sound too bad for how much money we have with them. Probably all our money together is like $1.4 million, including our work 401k. And with Edward Jones, we probably have about $700,000.
The truth about Ed, let's get to the bottom line.
We
here.
don't
First
just
of all,
hate Ed Jones, by the way.
Well, I kind of do because he took my lunch money in the 7th grade. So, or was it 6th?
And look at the success he went on. Because of that lunch money stealing, he went on to form this giant firm, blanketing the nation with financial advice.
I'm the guy.
Yeah.
I thought you were going to say you found food somewhere else.
No, you funded it. Good for you.
All right. Okay. First of all, going back, because people say this all the time. Well, I already paid the commission, then I'm in the funds. It's okay. But let's talk about that for a moment. Most of the funds that you're in still have a high expense ratio, the amount you're paying out for example, not to brag, but now our portfolio, I think we should brag. Our portfolio is using exchange traded funds. The expense ratio, the thing that costs you every year, which most people have no idea what they're paying. Ours are now 0.1 on average. 0.1. I will bet you dollars to donuts that you're using American funds at Ed Jones.
Yep, they love American funds.
They love American funds. And I'll bet you dollars to donuts that you're paying, 0.5% or 0.6 or something like that every year. You don't see it. It simply comes out of your account. That's number one.
Growth Fund of America, 0.6%. Yeah. Growth Fund of America,
okay.
Class A, 0.6.
All right. So setting aside the commission. Number two, we know it's not our work. We know because you can look at decades of research that the aforementioned American funds et al. Actively managed funds over time underproduce index funds like the ones I just mentioned that cost 0.1%, right? Over time, they can't pick the right stocks. They don't know what part of the market to be in. They have no more guess about the future than you do. Well, they might have a different or better guess, but there's no reason to believe it will be any more conclusive or any more accurate. So again, actively managed mutual funds versus a passive or index approach. The numbers very clearly show that owning a passive or index portfolio has been better returns, certainly, again, and knowing what you own. We get into all the other reasons, but those would be two of the ones I'd have. Number three, when you say they're charging you on part of it, not another, that is very confusing to me. I don't know if they're having some sort of other fee involved here. So that's, I don't know what that means.
Well, they do fee-based advice too. But now I got to give them credit for this. I do have to give them credit.
You're talking Jones now.
Edward Jones. They have lowered the fees on their fee-based services to a 1.65%. On the first $500,000. Well, no, I'm sorry, 1.42. Edelman is 1.65. Edelman is 1.65. Fisher is 1.25. So Ed
I don't
Jones
like
isn't
anything
awful.
north of 1.
Yeah, but I'm just saying they're not awful.
Okay, but just again, let me finish the point. The point still remains. No, I think that you help. Thank you.
Trying to be fair.
I'm not criticizing you, but the thing that we always mention is we think you should only hire a 100% fiduciary, period. Because what could happen, the thing you mentioned before about, well, we got this insurance policy they sold me into, it seems like a good deal, etc. I'll bet you dollars to donuts I could go online right now and buy a life insurance policy, a term policy that'll be far cheaper than what you got sold at Ed Jones. I'll bet you, because that's a commodity. There's no reason to go through them. They can sell you products and collect commissions, which creates a conflict of interest. That's why I don't think you should use anybody like them, not specifically them.
Okay, and let me give you one of the things they may be arguing is that you, and this is very likely because I hear this all the time, if you put in more than $100,000 with the American Funds Group in A shares, you get breakpoints and you start not paying commissions. So that's probably what they're referring to. Probably.
A share being an upfront load, generally 5.75%.
Here's the interesting thing. If you buy a C share in the American funds, you instead of being 0.5, 0.6, 0.7% per year, they can be 1.3, 1.4.
Because they're taking the expense ratio plus all
the commission on an annual
commission
basis.
On and on. I just ran into that this week. Somebody had a C share and they don't realize they're paying 1.6% a year.
It's ridiculous. But here's the thing.
It really is.
Here's what makes Ed Jones so dear to people's hearts. Because Ed Jones has a business model that is brilliant. It's much like the Chick-fil-A model.
No, Starbucks, if you please.
No, but it's much like
They're on every corner.
No, but see, that's the thing. Starbucks are almost all corporate owned or franchisee owned.
No,
Ed
almost
Jones
all corporate,
offices are all they're all one or two person offices. They're all your neighbors.
True.
Chick-fil-A is owned by each Chick-fil-A is owned by a person in that store who actually runs it. They're your friends.
Doesn't mean you're going to get treated any better.
No, but it's hard to get rid of them.
It sounds more like affinity. Are we going to get into the couch story now?
Well, we're not going to get into the couch story yet because we don't have time. But,
all right.
But I think
the point
that's
is,
part of it. I think people get
that's
very,
not why
very
you hire somebody,
No,
though.
I'm just saying this is I'm trying to explain why they get so attached to these Ed Jones advisors. This is why. And this is Tom's right. This is a business decision, and it needs to be that.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at vestory.com, vestory.com.
For your real life and real future, Tom and Don are talking real money.
You want to find out what a fiduciary advisor feels like? A 100% fiduciary advisor? Well, give us a try. Get Vestory. We'll help you for free. One time. And the coolest thing is you're not going to get sold anything. We don't sell stuff, and we don't pressure people into becoming clients. We don't believe in that. We don't need to do that. We're doing just fine, thank you. But you want to try out a fiduciary advisor? Go to vestory.com, vestory.com, or call us at 800-386-3004. But the easiest thing to do is just go set up an appointment. We can help you figure out what your portfolio is in. You may not know what you're paying, like that C-share person. You may have a mess of stuff that you want to get fixed up. You could have all kinds of issues that we want to help you with. Just go to vestory.com, vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.